So we mentioned in last month's video that we'd gone into 2018 very cautiously positioned, and that caution has proved very fortunate in February, when markets again sold off quite sharply. So I'm going to focus on Mosaic Risk Model 3, which is our balanced portfolio, which comprises 40% fixed income, 50% equity, and 10% real assets. That portfolio was down 1.25% in February, as opposed to 2.5% for its benchmark. And year to date, it's actually down 1.25% versus 3.8%. So the benchmark is performing extremely well year to date. Since inception, the portfolio is up about 25.2% versus about 24.2% for the underlying benchmark, which means we've outperformed by about 4% over the last 26 months. But more importantly, we've done that with only about 70% of the underlying volatility, producing a Sharpe ratio, roughly speaking, 1.5 times better than that of the underlying benchmark. The main contributor year to date to this good performance has been our international equity allocation, and in particular it's worth mentioning both Artemis Global Income and Fundsmith, who have performed extremely well in the first 2 months of this year. Going into March, we continue to be cautiously positioned. We think that the likelihood of further Fed interest rate rises this year will keep markets cautious, and as a result we may even start looking to book some of the profits that we've made, some of the outperformance we've made, with a view to just trying to navigate these more challenging conditions.